Most personal finance advice is too complicated. Too many rules, too many spreadsheets, too many systems that require 45 minutes of admin on a Sunday evening to maintain. And the result is that most people abandon the system entirely within 3 weeks, go back to spending however they feel like spending, and end up no better off than when they started. Today, we are going to do something different. We are going to strip the entire subject of personal finance in the UK down to its absolute core. The minimum number of rules that, if you follow them consistently and nothing else, will keep you financially secure for the rest of your life. Not rich necessarily. Not financially independent by 40. Just genuinely, solidly, reliably financially secure in a way that most British people never actually achieve. Because the research is consistent on this. Financial security is not primarily a function of income. It is a function of a small number of habits applied consistently over a long period of time. The people who are financially secure in Britain are not the people with the highest salaries. They are the people who understood a handful of simple rules and refused to break them, regardless of what the economy, their social circle, or the advertising industry was telling them to do. Here are those rules. Rule number 1. Spend less than you earn. Always, without exception. This sounds so obvious that writing it down feels almost embarrassing. And yet the data on British household finances in 2026 tells a story that makes this rule anything but obvious in practice. According to the ONS, millions of UK adults are reporting significant financial anxiety and difficulty keeping up with essential bills. The average British household carries credit card debt. A substantial proportion of working people in the UK arrive at the end of each month with nothing left over, and sometimes less than nothing. The gap between income and expenditure is negative for a meaningful portion of the working British population, not because they are not earning enough, though that is a separate and real problem for some people, but because spending has expanded to meet and sometimes exceed income at every level of the earnings distribution. People earning £30,000 a year are spending £30,000 a year. People earning £60,000 a year are spending £60,000 a year. People earning £100,000 a year are spending £100,000 a year. The lifestyle expands, the commitments multiply, the direct debits accumulate, and somehow, regardless of the income, the margin between what comes in and what goes out remains stubbornly close to zero. The minimalist money version of this rule is simpler than any budget system you will ever be sold. Before you spend money on anything that is not essential to your survival, a fixed portion of your income must already be gone, not saved after you have spent everything else. Gone first, automatically, on the day your salary arrives. The specific percentage matters less than the consistency. Whether it is 10% or 20% or 30% depends on your income, your commitments, and your goals. But the principle is non-negotiable. You pay yourself first, automatically, before the rest of your money has a chance to tell you it is already committed to something else. Set up a standing order to a separate savings account on the day your salary lands. The money that is not in your current account cannot be spent from your current account. This single mechanical action, which takes approximately 10 minutes to set up and 0 minutes to maintain after that, is the foundation of every genuine financial security story you will ever hear. Rule number 2. Build your emergency fund before you do anything else with your savings. An emergency fund is the single most important financial structure in your life. Not your pension, not your ISA, not your investment portfolio. Your emergency fund. Because without an emergency fund, every financial plan you build is one unexpected event away from collapse. Your car fails its MOT. Your boiler breaks in January. You lose your job, and it takes 3 months to find another one. Your landlord serves notice, and you need a new deposit and first month's rent immediately. Life sends these events reliably and without warning to everyone, regardless of income, regardless of career, regardless of how well you thought you had organized things. The question is not whether something unexpected will happen. It is whether you have built the buffer that allows you to absorb it without going into debt or raiding your long-term savings. The Money Smart guidance recommends 3 months of essential expenses as a minimum. Given the current cost of living environment in the UK, with mortgage rates still elevated and the job market uncertain in several sectors, 6 months is the more sensible target for most people. For someone spending £2,500 per month on essential costs, that is £15,000 sitting in a high-interest easy-access savings account, earning 5% or as close to that as you can currently get, doing absolutely nothing except being there. That is not exciting. That is the point. The emergency fund is not an investment. It is insurance against the kind of disruption that without it would force you to borrow money at high interest rates, destroy your long-term savings, and spend the next several years recovering. The cost of not having one is vastly higher than the opportunity cost of the return you are forgoing by keeping it in cash rather than investing it. Build it first. Keep it separate from your current account. Do not touch it for anything other than a genuine emergency. And define what a genuine emergency is before the emergency arrives. Because the temptation to redefine your emergency fund as your holiday fund or your new sofa fund is a well-documented human tendency that defeats the entire purpose. Rule number 3: never pay interest on something that loses value. This is the rule that separates the financially secure from everyone else more cleanly than almost any other. Credit card debt, personal loans for consumer goods, buy now, pay later schemes, car finance at high interest rates. All of these represent the same fundamental error. You are paying money to own something that is worth less every day you own it. A television bought on a credit card at 19% APR costs you far more than the ticket price. Once you account for the interest you pay every month, you carry that balance. A car purchased on a personal loan at 8% interest is simultaneously losing value through depreciation and costing you money through the interest payments on top of that. The combination of depreciation and interest charges means that you are paying well above the actual value of the thing you are buying for something that is worth less and less over the period you are paying for it. This is not a subtlety. It is the mechanism through which a significant amount of the money that working British people earn is transferred directly to financial institutions in exchange for the psychological comfort of having things now rather than later. The minimalist money rule on this is simple. If you cannot pay cash for it today, you cannot afford it today. Wait until you can. The one exception most financial advisors accept is a mortgage, where you are borrowing to own an appreciating asset rather than a depreciating one, and where the alternative is paying rent in perpetuity. Everything else, fund it from savings or do not buy it. Rule number 4. Maximize your ISA allowance before you do anything else with your investment money. The stocks and shares ISA is the most tax-efficient investment structure available to ordinary British people. In the 2026-27 tax year, you can put up to £20,000 per year into an ISA, and everything inside it, the growth, the dividends, the capital gains, belongs to you in full. No income tax on dividends. No capital gains tax on profits. No tax return to fill in. No CERC involvement of any kind. If you invest £20,000 per year in a stocks and shares ISA, earning 7% annually, you will have approximately £400,000 after 20 years. Every pound of that growth is yours. If you held the identical portfolio outside an ISA in a general investment account, you would be paying income tax on dividends at your marginal rate and capital gains tax on profits above your annual exemption. The ISA removes that friction entirely, compounding your returns at the full rate rather than the after-tax rate. The minimalist approach to investing in the UK is this: one account, low-cost global equity index tracker, maximum contribution you can afford, repeated every year without fail. You do not need a financial advisor to manage a diversified portfolio of global equities. You need a stocks and shares ISA with a low-cost provider such as Vanguard, iWeb, or Trading 212, a global index fund with a total expense ratio under 0.2%, and the discipline to contribute to it regularly and leave it alone. The biggest threat to long-term investment returns is not market volatility. It is the investor's own tendency to sell when markets fall and buy when they rise, which is the exact opposite of what compound growth requires. The minimalist investor does not watch the market. They contribute, ignore the noise, and wait. Rule number 5. Use salary sacrifice for your pension before you do anything else with your gross income. The pension is the most tax-efficient savings vehicle in Britain. Salary sacrifice, where you redirect a portion of your gross salary into your pension before it is taxed, saves you income tax at your marginal rate, saves you national insurance at 8% on income below £50,270, and often saves your employer national insurance too, which many employers pass back to you as an additional pension contribution. For a basic rate taxpayer, every £100 you sacrifice costs you only £68 from your take-home pay, but adds the full £100 to your pension. For a higher rate taxpayer, the same £100 costs only £58 from your take-home. This is an instant tax-free return before a single pound of investment growth has occurred. The minimalist pension rule is straightforward. First, always contribute enough to get the maximum employer match your employer offers. If your employer matches contributions up to 5% of salary and you are only contributing 3%, you are leaving free money on the table. Free money that, over a 20-year career, compounds into tens of thousands of pounds you will never see because you did not claim it. Second, after the employer match is secured, use salary sacrifice to bring your adjusted net income below £100,000 if you are approaching that threshold, because between £100,000 and £125,140 the effective marginal tax rate is 60% due to the personal allowance taper. And salary sacrifice is the most direct way to avoid it. Rule number 6. Own fewer things. This rule is the one that the consumer economy has spent decades, billions of pounds, and extraordinary creative energy trying to stop you from following. Because the entire model of modern consumer capitalism is built on the premise that you should always want more. A newer phone, a bigger television, a better car, a more stylish wardrobe, more furniture, more subscriptions, more stuff. And the financial cost of that more is not just the purchase price, it is the storage cost, the maintenance cost, the insurance cost, the mental load of managing the complexity of owning it, and the lost investment returns on the money that was spent acquiring it rather than compounding over time. The minimalist money insight here is not that you should live as an ascetic or deny yourself everything enjoyable. It is that every pound you spend on something you do not genuinely need or regularly use is a pound that could have been compounding in your ISA or your pension. And over 30 years, the difference between spending £1,000 per year on things you do not need and investing that £1,000 per year instead is the difference between nothing and approximately £94,000 at 7% annual growth. That is the real price of clutter. Not what you paid for it, what it cost you in foregone compound growth over the time you owned it. The British consumer spending culture is extraordinarily sophisticated at making things feel necessary that are not, at creating social comparison anxiety that drives spending, at making you feel that not upgrading, not buying the new version, not participating in the latest trend represents some kind of personal failure. The financially secure people in Britain are the ones who have developed immunity to that pressure. Not through misery or deprivation, but through clarity about what actually matters to them and what is just noise. Rule number 7. Never make a major financial decision under emotional pressure. This is the rule that saves you from the others, because all the ISAs and pension contributions and emergency funds in the world can be undone by a single bad financial decision made at the wrong moment. Taking on a mortgage you cannot comfortably afford because you are emotionally attached to a specific property. Cashing in an ISA during a market downturn because the falling balance is generating anxiety. Taking on debt for a car upgrade because you feel your current car reflects badly on you. Pulling money out of a pension early because a financial emergency, which your emergency fund should have covered, has arisen. All of these decisions happen at moments of elevated emotion, where the psychological pressure to act is at its highest and the quality of the decision-making is at its lowest. The minimalist rule here is a simple delay. For any financial decision involving more than £1,000, impose a mandatory 24 to 48-hour waiting period between the moment you feel like making the decision and the moment you actually make it. For decisions involving more than £10,000, the waiting period should be at least a week, and the decision should be reviewed against your written financial goals rather than made from the feeling of the moment. Most bad financial decisions in British households are made in the heat of something: excitement, fear, social pressure, grief, ambition. The decisions that compound into genuine financial security are almost always made calmly, deliberately, and in alignment with a clear sense of what you are actually trying to achieve. These 7 rules are not new. They are not exciting. They do not require a subscription to a financial app, a spreadsheet with 17 tabs, or a dedicated Sunday evening of money admin. They require clarity, consistency, and the willingness to resist a consumer culture that is working extremely hard to prevent you from following them. The people who are financially secure in Britain are not, for the most part, the people with the highest incomes. They are the people who understood these rules early, applied them consistently, and refused to let the noise of the system around them override the logic of what they knew to be true. That option is available to almost everyone. The question is whether you are willing to take it. If this video gave you something clear and actionable, please hit the like button and subscribe to UK Finance with Peter for more straight-talking content on money for people living and working in Britain. Thanks for watching, and I will see you in the next one.